Okay, this is the first time I've used this tool. It's called Explain Everything. And so hopefully we can get through this and not be too painful. But one of the things in Chapter 14 that you have to be able to prepare is a manufacturing statement. And so the manufacturing statement gets us to calculate the cost of goods manufactured. We didn't have to do that in Accounting 211 because we worked with merchandising companies that bought the materials already made. Now we're working in these first few chapters with manufacturing companies where they're actually making the product. So when you're preparing a manufacturing statement, you start off with adding all the goods together that were added during the period. So we're looking at direct material, direct labor, and overhead costs. Those are the three product costs that are added during the period. So this is the total costs added. Okay, then you add that to what the goods in process that you had that were partially complete at the beginning of the accounting period. Because you're going to have some goods that are sitting there that are just partially complete that have to be completed before you move on to anything else. So when you add together the costs that are added during this period together with the goods in process that were partially completed at the beginning of the period, you've got your total manufacturing costs. Just like we talked about inventory in Accounting 211, where we said your items that you've purchased, they're either still sitting there and become your ending inventory, or they're sold and become cost of goods sold. Same thing with your goods in process, or the total manufacturing costs. Those costs are now, those goods are now either complete and they have to be moved over to the finished goods inventory, or they're still sitting there partially complete and they become part of the goods in process inventory at the end of the accounting period and go on your income statement. So if we subtract out the goods in process at the end of the period, the ones that are still sitting there partially complete, that will give you your cost of goods manufactured for the period. And I'm going to abbreviate that, cost of goods manufactured. So the cost of goods manufactured, is what you're trying to calculate when you prepare the manufacturing statement. The cost of goods manufactured is the amount then that is moved to your finished goods inventory. So you would credit your goods in process inventory for this amount and debit your finished goods inventory, because now these goods are completed and they need to be moved over to the finished goods inventory so that they can be sold. So now if we look specifically at a problem and put some numbers to this, let me go to another slide. Let's see if I can figure out how to do that. Okay, I'm going to look at exercise 14-12 on page 641 of your textbook. This is asking us to prepare a manufacturing statement for Shanta Company as of December 31st, 2013. But you can see when you look at the problem that it doesn't give us the direct materials specifically. We have to calculate it. So that would be the first thing that we have to do, is calculate how much direct materials was used. And we can do that by taking the beginning raw materials inventory, add the raw materials that were purchased during the period, and subtract out the ending raw materials inventory, and that'll tell us the total amount of materials that were used. So again, we're adding in direct materials. That's always the first thing. However, they didn't give us the amount of direct materials that was used, so we were having to calculate it. So DM is my abbreviation for direct materials. So in order to calculate that, we have to take the raw materials inventory at 12/31, 2012, because that would have been the beginning of the year. And if we look for that amount in the problem, it's $37,000. All right, and then you add to that the purchases that were made during the year, the raw materials purchases. And if we look for that amount in the problem, it was $175,600. We add those two together, you get what, 6, that's 12, it's 10, 11, 212,600 is total materials available. I'm just abbreviating here because I don't have a whole lot of room. And then if you subtract out your ending raw materials inventory, the amount that's still left there at the end of the year, that'll tell you how much you've used. So the ending raw materials inventory was $42,700. So if we subtract that, we get a total amount of direct materials inventory of $169,900. I'm sorry, not direct materials inventory, direct materials used. Okay, so that's the amount of materials that were used that would have been taken out of the raw materials inventory and put into the goods in process inventory. We've used $169,900 worth of materials to process the goods that we're manufacturing. Okay, so to this $169,900, we have to add in our direct labor, which if you look in the problem, direct labor is specifically given to you, and it's $225,000. And then we have to add in our overhead, factory overhead. They don't give us the total amount of factory overhead, but they give us a number of items that could be included in overhead. So you have to look at the problem and determine which of these items should be included in overhead. And let me shrink this down some so we can fit this all on here. So if we look at the problem, remember factory overhead is those things that are used in the production process that aren't direct materials and aren't direct labor. So anything having to do with the factory, indirect labor, people that are working in the factory that aren't directly on the assembly line touching the products. You have factory equipment that you have to pay for. You might have rent on the factory building. You might have utilities, personal property tax on the factory building. You might have a supervisor's salary. Remember, the supervisor isn't directly on the assembly line, so his salary would also be manufacturing overhead. So anything that you see in the problem that has to do with the factory or the production process that's not part of direct materials or direct labor is generally factory overhead. So we have to add all of these items together to come up with our total factory overhead. So when I'm looking at this particular problem, I see factory computer supplies used. So that has to do with the factory. So I'm going to add that in to get my total factory overhead, and that is $17,840. Oops. The other thing that I notice is indirect labor. Again, this could be anybody that works in the factory that is not directly preparing or on the assembly line. It could be repairs and maintenance staff. It could be your janitorial staff. It could be anybody that is not directly assembling the product. So indirect labor was $47,000. I've got repairs to the factory equipment. And that amount is $5,250. And then the other thing I see that has to do with the factory that's not a direct material or direct labor is rent for the factory building. And that is $57,000. Okay, so if we add these four items together, we'll get our total factory overhead of $127,090. Sorry, I'm still getting used to moving this thing around. Okay. So now if we look at the problem, we've got direct materials used of $169,900, we've got direct labor used of $225,000, and we've got overhead of $127,900. If we add these three numbers together, we'll get our total costs added during the period. And that's the total cost added to goods in process. So when you add those three together, the 169.9, the 225, and the 127.090, which is your overhead, you're going to get total costs added during the period of 521,990. Okay, so that's just the adding together the direct materials, the direct labor, and the overhead, which are the three product costs that go into making the goods that you're manufacturing. So these are the costs that are added to my goods in process during the period. So now again, if we add what we started with at the beginning of the period, which is your goods in process inventory at 12/31/2012, that's what we would have started with. And if you look at the problem, it tells us that the beginning goods in process is $53,900. Okay, we add these two together and you get $575,890. That's our total cost of goods in process. And again, the GIP stands for goods in process. Okay, so this is what we started with at the beginning of the year, the 53.9, and then we added some more direct materials, we added some more direct labor, and we added some more overhead of 521,990. So the total amount we have at the end of the period is $575,890. And again, some of this is going to be finished, in which case it gets moved to the finished goods inventory. And some of it is still going to be sitting there incomplete, products that are partially completed. And so those will be your goods in process inventory at the beginning of, at the end of the accounting period. Okay, so now what we have to do is we have to subtract out those items that are left at the end of the accounting period in order to figure out how much was actually transferred out, or what our goods in process manufactured is. That's what that's called. So at the end of the accounting period, our goods in process inventory was $41,500. So if I subtract that from the 575, that gives me my cost of goods manufactured, and I'm just going to abbreviate that. So we got $534,390. Okay, so you take the total cost that was added during the period, add in what you started with at the beginning of the period, that gives you a total cost of goods in process to date of $575,890. Then they gave us what was still in process at the end of the accounting period, so if we subtract that from the total cost, that gives us the amount that was actually manufactured. So when we're preparing our journal entries, we learn all the journal entries in the next chapter. When we're preparing our journal entries, this amount here, this $534,390, will be the amount of our journal entry where we move the amounts from the goods in process inventory into the finished goods inventory so that they can be sold to the customer. I'm just messing this all up right here. Okay. So when we learn the journal entries in the next chapter, this will be the amount that gets debited to the finished goods inventory, and you'll credit the goods in process inventory. All we're doing is moving it from one inventory to the other. Remember, with a manufacturing company, you've got three inventory accounts. You've got a raw materials inventory, which just sits there and houses all the raw materials that you're going to use during the manufacturing process. You've got your goods in process inventory, which are all of your components, your product costs that are accumulated during the manufacturing process. And then once they're finished, those finished goods get moved out of the goods in process inventory into the finished goods inventory. The finished goods inventory is the one that you're going to sell to the customer. So to finish off this journal entry, we would be debiting finished goods inventory because inventory is an asset. So in order to increase that, you have to debit it, and then you'd be crediting the goods in process inventory because we're trying to reduce that. That's the amount that was finished off and transferred over to the finished goods inventory. Okay, so let me see if I can shrink this down so it all shows up on the page. Gets kind of small. I guess you can always rewind back. Okay, so that's the cost of goods manufactured, and that's how you calculate it. That's what goes on a manufacturing statement.